Hi, everybody. My name is Jeff Fowler. I'm with the Apartment Owners Association, and it is just a gorgeous day today, and I hope you're having a great day. We are really just privileged to have a great speaker, an expert in his field with us to talk about 1031 exchanges, how we can use those to lower our taxes. And just a little bit about AOA. We are one of the largest individually organized groups of apartment owners here in the state, and our goal is to give you ideas, to constantly give you ideas to help you make and or keep more money than ever before. And so we have the magazine, we have these live streams, and we have a e-newsletter that you can receive as well. So I encourage you to subscribe to that, and because there's all kinds of things going on. There's new laws that are being passed, and there's also live streams that we can tell you about that you can register for. And so to do that, you go to aoausa.com, and then if you go scroll all the way down to the bottom on the right side, there's a place for you to sign up for that newsletter, and then you'll be kept up to date. And a couple things that are coming up. Well, in the past, I guess we just recently had Dennis Block speak about the recovery time period. Michael Brennan spoke about it. Both of those are eviction attorneys. And then we had Richard Beckman also speak about it. And he also is an eviction and landlord-tenant attorney. And so we really tried to cover that for you. You can catch those if you go to YouTube and you just search for AOA USA, you'll see all the different videos that come up. Anyway, so one thing about AOA that I would like to mention is that is just the tenant screening. And just real quickly, we have a double whammy eviction report that shows it takes two different reports and shows you eviction records. It covers so much because it's two different companies that we're using. And then we also have a criminal report that covers, it's not just the criminal data, but it also gives you a previous address history as well as an alias search. And so it'll take that social security number, verify it, and show you other names that it's been used with. And when you couple that also with a credit report, all that is $16.95. So it's really quite a deal to get such a comprehensive report. We have other reports that are even more comprehensive than that. So check it out. It does require a site inspection, or you can get you can get a credit report that just gives you a grade if you don't want the site inspection. But anyway, wanted to tell you about that because that's something that'll just really save you lots of times and lots of headaches for sure. All right, and also I want to say if you would like closed captions, please go to the Facebook page and you can watch this live with the captions. And YouTube doesn't have it live with captions. After the fact, it does. So anyway, just want to mention that to everyone out there that like to see it. All right. Okay, so this event is sponsored by Real Estate Transition Solutions. So if you're looking to make a transition and make your property way more passive, then they will help you. They have a solution for you. And every year they do about 220 million in replacement properties, and they've been around. They're nationwide, but they have 3 offices on the West Coast and 1 in San Francisco, I believe. And it's a real estate advisory firm. So they're here for you. This is what they do. And so from there we have our speaker today, and he's a partner in the firm, and he also is a CPA, used to be an auditor with PwC. So this is a high-level guy. You don't get to work there unless you really are sharp, and he is sharp, as you will see today when he speaks. He's grown up in the industry. He comes from a family that's owned real estate, so he gets it. And so it's my pleasure to introduce to you today Austin Bowlin.
AOA for the opportunity to present today and share some educational information on 1031 exchanges. As Jeff mentioned, my name is Austin Bowlin. I'm a partner at Real Estate Transition Solutions. We are actually headquartered up in Seattle, Washington, with offices throughout the West Coast in Portland and in San Francisco as well. So today we are going to talk about what many would consider to be one of the most advantageous sections of the tax code, which is Section 1031. We'll walk through some of the mechanics and the rules and timeline associated with 1031 exchanges, and also talk about some of the opportunities and strategies available there as well. One of the replacement property options that we will mention in brief, really not the focus of today's webinar, is going to be the Delaware Statutory Trust. Now, the Delaware Statutory Trust qualifies as what's considered like-kind property via 1031 exchange, so meaning you can exchange into Delaware Statutory Trust property, but it is also a registered security with the Securities and Exchange Commission. And as such, there's a requirement that in order to invest in Delaware Statutory Trust property, you must be what is considered an accredited investor, meaning having a net worth in excess of $1 million, not including the value of your primary residence. Or alternatively, you can meet the accreditation threshold through an income test, which is $200,000 as an individual, $300,000 if married filing jointly. And lastly, there's a number of professional designations or certifications that you can hold that will also classify you as an accredited investor. So before we go too far, a little bit of background on our firm. Real Estate Transition Solutions is a real estate advisory firm that focuses on serving property owners who are navigating what we consider to be the transition from the third to the fourth quarter of property ownership. Now, while there's a correlation, it's not a perfect correlation between the third to the fourth quarter of life. For most property owners, this transition occurs somewhere between, say, 50 to 75 or 85 years old. But commonly, what it is a period of time in which you're starting to look at the investment property that you own, understand that if you were to sell it, there would be significant tax consequences associated with that. And looking at your particular objectives, both financial and lifestyle, and seeing a gap between those objectives and the real estate currently owned. Now, one of the major benefits of investment real estate is that if you continue to own investment real estate until eventually you or spouse in community property states such as California, such as Washington, pass away, then the accumulated capital gains, accumulated depreciation, net investment income tax, state income tax, all of which would not have ever been paid given the fact that you either did not sell or when you did sell, you did a 1031 exchange. All of that's eliminated upon the passing of an owner or spouse of an owner. So there's a strong benefit for continuing to own investment real estate until passing. The question often becomes what form of ownership, what property type is going to be reflective of your objectives for the current chapter of life in which you're in. The firm was founded about 20 years ago by my father, Roger Bowlin. He began his career in traditional commercial real estate, followed by a few decades in what many would consider traditional wealth management. So they're stocks and bonds, managing accounts on behalf of clients. And that's at the point in time in which he really established the framework through which we use as a firm for dialoguing on and developing and then ultimately identifying what the financial objectives and lifestyle objectives are for a particular owner. Where do they fall from a income objective standpoint, appreciation, diversification, risk tolerance? How does estate planning fit within the mix? All of that is taken into account and really builds out a framework that we utilize then to evaluate the properties that are currently owned and other available options. I joined the firm 5 years ago. I'm a CPA by background. Previous to working at Real Estate Transition Solutions, I was at a large public accounting firm PricewaterhouseCoopers, first in their audit practice, and then followed by their mergers and acquisitions advisory group. And we have a team of licensed 1031 exchange advisors, analysts, due diligence, investor relations concierge, all the resources needed to serve a client and make sure that any sort of transition that we're working with them on is going to be effective and a smooth process. Here you'll see what we're planning on covering today. So we've quite a bit in store, and while Section 1031 of the tax code is a fairly short section, all of a few paragraphs, there's quite a bit of depth in terms of the rules and the further guidance that the IRS has put forward. So very, very narrow, but a deep section, and really has an industry in and of itself built around it. So we'll talk about just what a 1031 exchange is, and we'll talk through some of the benefits, what sort of considerations individuals are taking into account when asking themselves, should I do a 1031 exchange? And if so, into what? We'll talk about the rules, the mechanics, the timeline. And we'll walk through a couple illustrative replacement property options, a case study, and then we'll open it up for questions as well. So as I mentioned before, some would say, many would say, in fact, that Section 1031 is perhaps the most advantageous section of the tax code. And the reason being is what it allows for is it allows for, as long as the proper timeline and rules have been adhered to, it allows for an individual or an entity to sell investment real estate and then take the sales proceeds from that sale, the sale of what was referred to as a relinquished property, and reinvest those sales proceeds into replacement property while deferring all of the tax that would otherwise be due upon that sale. So, for instance, if you were to sell a duplex for $1 million and the tax liability as a California resident on that duplex may be $350,000, then instead of paying tax off of that million, having $650,000 to invest in new property, you can defer all of that tax and purchase $1 million or more of real estate and not ever take that haircut. Now, many people will say, what's the point of deferring the tax if eventually I'm going to have to pay it? And that goes back to what I mentioned on an earlier slide of, if you continue to defer your tax via either not selling property or performing 1031 exchanges, then you can eventually get your step up in basis so that that deferred tax liability is eliminated upon the passing of a spouse or an owner, and then inherited by either surviving spouse or beneficiaries without any tax consequences. A lot of people who start their research on 1031 exchanges and exploring it as an option hear the phrase used of like kind and immediately assume that that is a narrow definition that suggests if you were to sell that duplex for $1 million, you would need to purchase another duplex as your replacement property. Or perhaps you would need to purchase another rental property of some sort, residential rental. And there's not the ability to transition into different property types in different geographic areas. The reality is that the definition of like kind, as put forward by the IRS, is quite broad. And the IRS is not concerned with any particular property type, but instead is looking at the intent as to why that property is owned. So in this regard, we really only have 3 categories. We have, when talking about intent, we have investment property held for business or investment purposes. We have personal use property. So think your primary residence or a second home, vacation home, but used predominantly for personal use. And then we have a third category that's referred to as dealer inventory. And what would fall under this umbrella would be individuals who are doing fix and flips, where they're purchasing a property, improving it, and really the intent is to in the near term, turn around and sell that property, or if you're a home builder or developer or something to that effect, typically not having any rental income derived from the property. So those are your three buckets. And within held for business or investment purposes can be any property type: agricultural land, hospitality, could be multifamily, self-storage, industrial, and so on and so forth, all of which are like kind with one another. So you can very much sell a duplex and exchange into pasture land in Kansas, or you can exchange into timberland in Montgomery, Alabama, or you could exchange into a hotel, or you could exchange into an industrial or self-storage property, and vice versa. All of those are like kind with one another. There are also a few ownership structures that the IRS has approved as qualifying for 1031 exchanges, which is the tenant in common structure and the Delaware statutory trust structure as well, both of which, as a not property type but form of ownership, also qualify for 1031 purposes. We'll talk more on those on a later slide. Now, there are multiple reasons as to why someone would consider doing a 1031 exchange. Now, keep in mind, even as a 1031 exchange advisor, I am not a believer that the exchange is appropriate and suitable for every single investor in all situations. As much as I advise clients to pay as little tax as possible, because that is effectively guaranteed return, that we know the amount, we can calculate what would be the tax liability, and if we don't have to pay it, then no risk associated with that portion of the return. But that being said, there are a number of benefits that should be taken into account and then compared to your particular situation and objectives. The first, as I mentioned, is going to be the tax savings. Very, very relevant for California taxpayers when you look at where that tax rate can be in combining not only capital gains, but state income tax, not only depreciation recapture at 25%, but also state income tax, and adding the 3.8% net investment income tax on top of that. It's not incomprehensible to get up to 42% for your tax rate that would be applied to a portion of the sales proceeds resulting from a sale in California. Many people are looking at utilizing 1031 exchanges because they want to have a different return profile associated with their investment real estate as well. I'll give you an example of that. So if you own, say for instance, a single family rental property in Pasadena, well, depending on how long you've owned that property for, you've probably done incredibly well from an appreciation standpoint, especially if that property was purchased 5 or more years ago. So when we look at the return profile associated with that property and understanding that return is always going to be comprised of two components, income and appreciation, in aggregate, that property's done very, very well. But it's also heavily weighted toward appreciation. And if we were to look at the return on equity from a cash flow standpoint alone, it's likely that that property is producing 2.5% cash flow when we compare the net income to the available equity within that property. At a certain point, many property owners will say, I'd like to shift my investments towards real estate that's going to be more balanced when we look at that income and appreciation equation. I don't necessarily need to have 8-10% annual appreciation when I'm only getting 2% cash flow. I'd rather have something that's more in the 4-5-6% cash flow realm paired with maybe 4-5-6% appreciation as well. So enhancing income and really shifting towards properties that are going to be more evenly balanced, that's a common consideration for property owners that we work with as to why they would consider selling a property and doing a 1031 exchange. Another component is just moving markets too. And we see this more and more when looking at the regulatory environment, that everyone on this webinar is feeling up and down the West Coast, really. It's not California alone. It's not Los Angeles or San Francisco alone. It's everywhere at this point in terms of how difficult it is to operate single family through multifamily properties. So folks are looking at 1031 exchanges also as a mechanism to continue to defer their tax liability and eventually have that elimination of that tax liability for estate tax purposes, that step up in basis. Also looking at diversification. It's very common for a property owner to build a skill set or expertise in a particular property type, and then also acquire in a single geographic area. Understandably, that's often within a commutable distance of where they live. So if you're looking at property in South Bay and San Jose area, maybe it's 2 to 4 unit buildings throughout the Southern Bay, and you own 3, 4, 5 properties there that may represent 60, 70, 80% of your net worth in real estate in one market, in one property type. That's a phenomenal way to build your wealth. Often concentration is necessary when building wealth. It's not what most would recommend from a preservation of capital standpoint, given that different property types in different geographic areas are going to behave in various ways throughout market cycles. So looking at having exposure to self-storage or net lease retail, medical office, industrial properties, whatever it may be, to balance against the exposure you have to residential multifamily properties. That's a common objective of individuals. Now, they may not feel comfortable or have the sales proceeds to acquire, say, a storage facility on their own and manage it. But there are forms of ownership like the Delaware Statutory Trust that we'll discuss a bit later on that would allow them to have exposure to that property type, invest in it without the management responsibility. The last is passive management options. Well, this is one in which I'm sure everyone here feels, but managing investment real estate, whether directly or overseeing third-party property management, that requires time, energy, and effort. And as we're all aware, the phone calls you receive, the issues that come up are typically at the worst times: evenings, weekends, holidays, during cold spells, whatever it may be. So as we get to the point in which owners are aging, they're often saying, I've worked hard, I've built a healthy portfolio, I have a strong net worth at this point as a result of real estate, so it's worked well for me, but now I'd like to not be as actively involved in the day-to-day management. I'd like to have passive options. I'd like to have that diversification. I don't want my properties to end up owning me. I also don't want to find myself in a situation where if I'm taking lead on the properties and I were to be injured or disabled or, heaven forbid, pass away, that my surviving spouse who may not have the same level of familiarity and expertise with the properties would then have to take those properties over and figure out what to do. Or that my children would end up co-owning these properties, which I can assure you is something in which you want to avoid. Having worked with many families where we're working with that second generation, it's one thing to allocate specific properties to each beneficiary, each child. It's another thing to force them into a co-ownership arrangement. And it's really, really sad when there are siblings that would otherwise likely have great relationships with one another if they didn't co-own and co-manage properties together. So passive management options, those become increasingly popular as folks are moving into that fourth quarter of ownership. Now, what are some of the considerations that are going to ultimately motivate someone to do an exchange? If you're interested in learning about it and you're saying, okay, this is something I'm intrigued by, but does it make sense for me? What you're often going to be asking yourself is, first and foremost, what is my tax liability that would be due if I were to sell my property? That's a very key component in part of the equation of evaluating whether an exchange is suitable. Often they're looking at the, as I mentioned before, landlord-tenant laws, the regulatory environment, and saying, is this an environment in which I want to stay invested in? Do I see it getting better in any capacity? Is there hope? Is there light at the end of the tunnel? Or is it best now to pick up my chips and move them elsewhere? Do you want to enhance income, or are you happy with the current return profile of your property? Are you looking at any sort of market condition changes that might be occurring? Do you see there being more appreciation potential elsewhere? So all of which can be taken into account. Estate planning benefits, diversifying the asset base, eliminating active management, all other components that will be evaluated when considering if an exchange is correct. Here what we have is the timeline that we work off of, or the process for executing what we consider to be an efficient and well-organized 1031 exchange. Many will jump directly to the actual exchange timeline of sell your property, 45 days to identify your property, 180 days to close on your replacement property. Our approach begins much earlier than that. As an exchange advisor, we want to come alongside and make sure that we have a cohesive plan established, that the client's educated on what options are available, that we have those objectives determined, and that we can execute on a strategy that's going to have an end result that is moving the property owner much more closer to where they want to be over the next 1, 3, 5, 7 years. What that begins with is that calculation of the tax liability, first key input. Next is making sure that one understands the rules, the timeline, the mechanics of 1031 exchanges. And then once that foundational knowledge is established on the mechanics of the exchange, then we start to dialogue about those objectives: income diversification, estate planning, and so on and so forth. Then we get a lay of the land on what sort of replacement property options are available, what would be a good fit for a particular owner's objectives, looking at the return profile. So we were working with realistic numbers. And once all that background is done in the first 5 steps, now it's time to move forward with the sale of what will be referred to as your relinquished property. Now you can utilize your broker to sell the property just as you would in a normal transaction. I know AOA has some great resources available here in their own brokerage team, which I've heard nothing but good things about. So you very much can work with whomever you prefer from a brokerage standpoint to sell that property, with the one exception being is once you have a signed purchase and sale agreement and escrow is open, you then need to open an exchange with an entity that's referred to as a qualified intermediary. In effect, what the qualified intermediary is exchange escrow. It is the entity that will hold on to the funds while the exchange is being performed, so that you do not take what is considered constructive receipt of the exchange dollars while you're performing your exchange. From that point, upon the sale of your property, the close of escrow, you now have 45 days to identify your replacement property, followed by an additional 135 days, making for 180 total, to actually close on that replacement property. Once the exchange is completed, of course, you want to make sure that your tax advisor has all of the necessary documentation in order to record the exchange, and certainly make sure the tax deferral is showing on your tax return. Now, when we talk about the rules and the mechanics for a 1031 exchange, there's a couple of components that we'll touch on here. First off, like kind, definition being any property held for business or investment purposes. Second, the qualified intermediary. This is that entity. You'll hear them referred to as an exchange facilitator or an exchange accommodator that is going to hold on to the sales proceeds during the exchange and then release those proceeds when you have identified and would like to close on your replacement property. Legal ownership entity, the entity that is recorded on title, whether that's your name individually, yours and your spouse's, an LLC, an S corp, etc., that must be preserved through the 1031 exchange. So keep that in mind. The 45-day identification period, the 180-day close period, And then that puts us into the place in which we'll talk briefly about property identification rules. Upon day 45, you must submit your identification form to your qualified intermediary. Now, you can close on replacement property before day 45, but if you are planning on closing on property after day 45, you must submit an identification form. And there's 3 different approaches that you can utilize for identifying replacement property. Frankly, I think that this is completely arbitrary and a waste of time and effort that the IRS makes exchangers jump through. But this is what we've been told, and this is very strict guidance as to these 3 approaches. So you can either identify up to 3 properties, regardless of the value of the property. Of course, you do not need to acquire all 3 properties. You can acquire any combination of all or none. You can identify, as a second approach, up to 200% of the value of the property in which you sold, regardless of the number of properties that consists of. So you sell a property for $1.1 million, you can identify up to $2.2 million of replacement property. Whether that's 2, 3, 4, 5 properties in aggregate, does not matter. Or lastly, you can utilize what's referred to often as the all or nothing rule, or the 95% rule more specifically. And that means you can identify any number of properties for any aggregate value, but you must close on 95% of the value of the property you identify. Otherwise, the entire exchange is invalidated. That one's not quite as frequently used. We do work with it fairly regularly using the Delaware Statutory Trust in some specific situations. But if there's any risk that a property is not going to close, that is not an approach to be used for identifying your property. In order to have full tax deferral, you also have to purchase equal or greater value to the property in which you sold. So here you'll often hear a concept referred to as debt matching, which is not really the best way to articulate it. There's really 2 rules that you have to keep in mind from a value standpoint in order to have full tax deferral. When you sell your property, say you sell a property for $2 million, and that results in $1.8 million in net sales proceeds. When you sell that property, you need to purchase at least replacement property that is equal or greater to the value of that net sales proceeds, that 1.8 million. And you have to use all of the equity resulting from your sale. So in the example over here on the right, you'll see property value 500, debt and mortgage 200, equity value 300. This has nothing to do with what the gain was. The gain here could be $50,000, it could be $450,000. If you want to have tax deferral, full tax deferral, in this scenario, you would need to purchase $500,000 of replacement property and use all $300,000 of equity in order to purchase that replacement property. We'll do a quick pass through some of the replacement property ownership structures, and we have a number of other webinars that dive deeper into each of these 3 ownership structures. But what you'll see is the Delaware Statutory Trust, the tenant in common, and fee simple property ownership. The Delaware Statutory Trust is perhaps the one that the fewest number of you may be familiar with, likely given it's a relatively new form of ownership, 2004. So it's been around about 17 years at this point. But what it is a form of fractional ownership that allows for an individual to sell a property and exchange into owning a percentage of larger institutional quality properties. So when I use the term institutional, we're talking about the properties that you typically see being acquired by the likes of a REIT or pension plan, university endowment, sovereign wealth fund, etc. Very commonly, this is going to be a $40 to $100 million multifamily property or a portfolio of 8 to 13 self-storage properties, portfolio medical office, grocery anchored retail, corporate guaranteed single tenant retail like CVS's, Walgreens. Very commonly, those will be 20 to 30 properties packaged together in a portfolio. And the benefit is that the investment minimum is fairly low, typically 100,000 of equity. So you can sell a property, say you sell a property for $1 million, you can allocate 300,000 to 3 different DSTs and really create a diversified portfolio custom to your particular objectives that's going to be producing income for you. And then eventually those properties will be sold and you can do a subsequent 1031 exchange down the road. On average, the hold period tends to be about 5 to 7 years. Completely passive from a management standpoint. All the tax reporting is compiled and provided to you to plug onto your tax return. So really one of those options that allows you to have many of the benefits of investment real estate with diversification, with preserving that exchangeability and the step up in basis, but not having to take that active management role or even oversee property management for that matter. The tenant in common structure shares a number of similarities with the Delaware Statutory Trust, given that both are forms of fractional ownership, but has less, call it, parameters around it in terms of what is and what is not allowable with the property. You can refinance tenant in common property. There's no restrictions on whether you can do ground up construction or what needs to happen with the income, how the income's split, et cetera. And so you'll see more extensive value add. You'll see some development deals done in the tenant in common. And typically when we're working with them, with clients, the investment minimum's far higher to usually $1 million. And then lastly, the fee simple ownership structure, likely what most of you are familiar with and own your properties within today. This is going to be anyone who owns a property with their own name recorded on title as an individual, married couple on title, LLC, S Corp, limited partnership, so on and so forth. A myriad of strategies available here. Certainly all of the rights and responsibility of management typically is going to be present within the fee simple ownership structure. We can talk about repurposing personal use to investment property here or vice versa. We can talk about heavy value add strategies. We can talk about assemblage plays. There's lots of different strategies available within the fee simple space. But very commonly what we see is property owners making a transition from having built their portfolio in fee simple ownership, then managing that portfolio so it's stabilized and operating efficiently, and then eventually saying even that management of the stabilized portfolio is more than I'd like to do at this chapter of life, or looking forward more than I'll want to be doing in 3, 4, 5 years, and it's a good market. And so migrating dollars over to something that ends up being more passive in nature. Here's a quick example to display what the impact is of a 1031 exchange from a return standpoint. So what we have here is a California resident taxpayer who sells a property for $900,000. And on the left side, you'll see the sell and pay tax scenario. On the right side, you'll see the sell, perform a 1031 exchange, and defer all of that tax scenario. And we're trying to make this as apples to apples with the exception of that tax being paid. So in both scenarios, $900,000 sale. On the left, we have a 42% effective tax rate that's going to be translating to $378,000 of taxes paid. And that gets us down to net proceeds of $522,000. On the right, we have $900,000, no tax paid, fully deferred, and then $900,000 of exchange proceeds, both invested into a property that, say, produces 5% cash flow. And you can see the difference. It's almost twice as much income that ends up being derived from the exchange scenario than it is from the post-tax scenario. And not only is that income, but it's also owning more property, having more appreciation potential, having more depreciation possible, and so on and so forth. Here's a quick case study that we'll just take a fast lap through. But this was a scenario of a couple we worked with in San Diego that owned a 10 unit that they sold in early 2020. The property had been fully depreciated. They sold it for $3.2 million. Net of the transaction costs ended up having just over $3 million in net sales proceeds. And going back to what we were talking about with that tax rate, they were looking at a tax bill of $734,000 almost. So significant tax consequences. It's amazing that you can work as hard as you do, grow up a portfolio, look at selling a property, and then say, wow, I'm going to pay a third or almost half of the sales proceeds in taxes. It makes no sense. So what they were looking at and why they wanted to sell the property is they were tired of management. They wanted to enhance their income. They were starting to think about their estate planning implications. And so we worked with them, met with them, and ultimately they opted and determined that the best option for them was going to be exchanging into a diversified portfolio of DSTs. What that looked like is a portfolio of 4 different DSTs. They had a multifamily property that was Class A new construction. They had a value add multifamily property, and then they had 2 portfolios of corporate guaranteed net lease retail properties. In total, that aggregated out at about, it was 26, 27 properties. And what happened, and this is exactly what we want to see, is they increased their annual income significantly, 60%, 64% increase, while simultaneously reducing their taxable income, because they went from owning $3.2 million of real estate free and clear, no debt, to now owning approximately $6.4 million of real estate, which generated significantly more new depreciation that they didn't have any longer because they had fully depreciated their property. So really an ideal scenario from the standpoint of addressing the financial objectives and addressing the lifestyle objectives. Why we encourage folks to work with a licensed exchange advisor is because they can explain many of these concepts and have access to the full breadth of options that are going to be available, whether it's sourcing properties through the brokerage channel and relationships there, or whether it is sourcing properties through what's referred to as the securitized channel, so the Delaware Statutory Trust, the tenant in common. Having the relationships and the ability to do so, the necessary licenses to do so, but also the familiarity in working through that process of understanding and developing those objectives alongside a property owner, dialoguing about them, posing various strategies, talking about the costs and the benefits and the risks and the rewards, and then ultimately helping execute that and simultaneously staying in communication with the other advisors that should and do have a seat at the table, your broker, your financial advisor, your CPA, so on and so forth. So there's quite a bit of value that can be created by working with a licensed exchange advisor. I'm very proud of our team at Real Estate Transition Solutions in terms of the care and diligence and attentiveness that clients whom we work with end up receiving. If you're interested in seeing any examples of Delaware statutory trust properties specifically, you can visit our website at re-transition.com/AOA. And there's a number of resources available that are specific to California property owners, but also you can request access to our Delaware Statutory Trust Marketplace to look at either recently closed funded properties, or if you're an accredited investor, currently available properties as well. Also, very much willing to have a conversation with you about the specifics of your own situation. If that's something in which you're interested in, feel free to reach out to us. We can schedule a complimentary consultation with one of our exchange advisors on our team. Best way to do so is by visiting that website that I mentioned before, re-transition/AOA, or calling us at the number or sending an email in at the email address you see at the bottom of the screen. Number of resources available on our website: our guide to understanding 1031 exchanges, our guide to investing in Delaware statutory trusts. Difficult to encapsulate all of this information in 45 minutes or so. So, very much would encourage you to go see it written down, charts explaining it, diagrams, etc. Very good resources to draw upon as you are are building out your knowledge and familiarity with exchanges and exchange options. And then we love webinars at RETS. Always have webinars coming up. Typically, it's on a weekly basis. So if you are interested in joining for future ones, you can visit our AOA member portal, and then you'll see upcoming events and go ahead and register for those there. So with that, I'm going to hand it back over to Jeff. We've got a couple frequently asked questions here, but I am happy to talk through any questions that may have come through from the audience and the attendees as well. You let me know which direction you'd like to go.
Okay, great. Well, thank you so much, Austin, for sharing with us. And if you hopped on this late and missed the introduction, this is Austin Bowlin, and he's with Real Estate Transition Solutions. And so anyway, they're sponsoring this event. And if you go, like if you look at this on YouTube, there's a little tab that has more kind of at the bottom. If you click on that, all of his information is going to be there. And so that link there, if you missed it, it'll be there. So just so you know, that's there. My name's Jeff Fowler, and with the Apartment Owners Association. And we're just trying to bring you content every week, just about that'll give you ideas to make more money. And so we're going to take questions now. And if you're watching this from AOAUSA.com, at the very bottom, you'll see a little blue help button. You can click on that and type your question in. I see we do have several questions already, so we can get started on that. And hey, thank you for mentioning the AOA brokerage. If you are in a place where you are getting ready to sell, then contact us. If you're in Southern California, specifically LA area, we'd love to work with you on that. We have guys that have been around forever. The John and Pamela's that case study there really puts meat on the bones and helps people understand how significant the savings are. So thank you for giving something so practical like that. And it was just, I liked it this time. It was real comprehensive. And for you guys to know, they're not going anywhere. Every month they're on this AOA live stream. So you can catch them the next month, and they try to cover slightly different things. And but they're here to help you avoid the grim reaper of taxes. Yep. So anyway, with that, we'll go ahead and look at this. And here's Sue Cortez. And first question: can you also talk about a reverse 1031 exchange? And so maybe, I don't know if you want to talk about that right now, or if that's a good topic for next month. I'm not sure. What do you think?
Give the quick and dirty on it, just to explain what it is. And then if there are follow-up questions, we can do a webinar focused on that specifically. What it is with the traditional exchange, you have the sale of a property, designate that you're planning on doing an exchange. Then you have your 45-day identification period, followed by your 180-day close period. So additional 135 days. That's a traditional exchange. You'll hear that referred to as a delayed exchange commonly. The reverse exchange has the same timeline, but as the name would suggest, in reverse. And what it requires is the individual to first open an exchange with a qualified intermediary, and then they tell the qualified intermediary, we're planning on doing an exchange. It's going to be a reverse exchange. We want you to purchase this property. The qualified intermediary will set up a special purpose LLC. It'll be an LLC that should be a new LLC. It's not been used for any other purposes, and then will be dissolved after that fact. So you're going to have to pay for that setup of the LLC, and then the individual lends money to the qualified intermediary to purchase the property. Qualified intermediary will purchase the property and take title in the LLC's name. Then once that purchase has occurred, the exchanger has 45 days to identify what property they plan to sell of theirs, and then an additional 135 days after that to actually close on that sale. In today's market, that is not a problem, selling a property in that timeline. So it works out well from that standpoint. Once the sale occurs, then you use the funds to effectively pay yourself back for the money that had been lent to the qualified intermediary to purchase the replacement property. And the qualified intermediary transfers title of the LLC, or transfers ownership rather of the LLC into the exchanger's name. So it sounds great because it removes much of the pressure of selling and then acquiring property in today's market. It's much easier to sell than it is to buy it. So I'm sure all of you are familiar with. Here's the drawback. One, it's slightly more expensive from a qualified intermediary standpoint. We're talking the difference between a traditional exchange typically being $1,000 to $1,500. Most reverse exchanges are around $5,000. That may not be a big issue. The bigger issue is that you have to have sufficient funds in order to lend the money to the qualified intermediary to purchase your replacement property before you have sales proceeds from your investment property. And while that may or may not be feasible for you, the larger the property we're talking about, the more funds it's going to require. Now, there are a few lenders that will bridge it, but you're typically talking about hard money in this situation. So you're looking at high origination fees and a very high interest rate. But the funding of the original purchase is the hurdle that most folks have a difficult time getting over for doing a reverse exchange.
All right. Okay, Jim, thank you for your question on YouTube. When Delaware Statutory Trust refinances or is sold, do you have to pay gains?
That's a great question. So the Delaware Statutory Trust is actually not legally allowed to refinance. So you will see that property being sold, and there's a couple different sales structures that we talk in further detail on our Delaware Statutory Trust focused webinars. But what will happen with the traditional Delaware Statutory Trust is after a period of time, on average, this tends to be 5 to 7 years, that property is sold, and all of the sales proceeds, including any of the appreciation potential that was occurred, that is distributed to the investors pro rata based off your percentage ownership. And you are free to either do another 1031 exchange, could be into another DST property, could be back into the local market, or pay tax, or any combination of. So in effect, you have all the same options that you would have upon selling your duplex or 10 unit or 30 unit today when that DST property eventually sells.
Great. All right. And Jim, I noticed that you had 3 or 4 questions packed in there. And what we normally do if we have our seminar, you may have been to one, or the $1 Million Trade Show that we have. Normally, what we do is just have one person ask one question, and then they go to the end of the line, and then they can ask another question. We do have several questions today, so we'll go through, and then I'll circle back around to your questions there. All right, the worship space. I paid $100,000 for an investment property that I want to sell for $450,000. If I clear $370 after commissions and $70K loan, can I pull out my $100K to my bank account tax-free and put $270 in a 1031 exchange?
No, you cannot. And that goes back to the slide that we were talking about earlier, right in the middle of the presentation. In order to have full tax deferral, you must purchase equal or greater property value to that which you sold and use all of the equity resulting from it. Now, you can absolutely pull the 100 and some thousand out and have that be a partial exchange and then trigger a tax liability for a portion of it. That's done all the time and very much an option, but not if full tax deferral is the objective.
Congratulations, you invested well, right? Art, here we go on YouTube. When I do a property search to do a 1031 exchange, I'm not a realtor. Is there a way for a property owner to access the MLS?
I think that is market by market in terms of who's managing the MLS. Up here in the Northwest, I know that they have a pretty high wall around their listing service. And that being said, I'm also quite confident that Zillow and Redfin pull their data directly from the MLS. So all of those properties should be showing up on some of the online services. They don't have all the detail that you'd see if you went straight into your MLS page. But no, without a brokerage license, I don't believe you can get MLS access. I know you can't get CEBA access as well. So you will likely need to work with a broker there.
All right. WMR Russell. Evan and Jay. Okay, so it's a bunch of them. How long do you have to hold the investment property to do a 1031 exchange?
Good question. That one comes up pretty regularly. And I think in part because folks search that question online and they don't see a straightforward answer. And it's because the IRS has not given a straightforward answer. There's not a bright line around you must hold investment real estate for 1 year or 2 years to have it qualify as like kind. Instead, it's all about what we talked about earlier, which is that intent. There's some scenarios whereby a property has been held for 5 years and hasn't qualified for exchanges. And there's some that have been held for a matter of months and then did qualify for exchanges. I'll give you an example of what that might look like. If you went out and bought a property and you said, I got such a screaming deal on this property that as soon as I close on it, I'm going to turn around and I'm going to sell it for 10, 20% more than I paid for it. Well, that property, if it took 2-3 years to sell it, it sat on the market, you weren't able to sell it, and then finally 3 years later you sold it, that would not qualify for 1031 purposes because your intent was not to hold it for business or investment purposes. Your intent was to flip that property. And even though it took 2-3 years to sell it, you had been trying to sell it the entire time. On the other side of the equation, if you bought a property and your plan was to hold on to it, hold it for business or investment purposes, rent it out, put your business in it, whatever it might be, and then all of a sudden some unforeseen circumstance happened, could be personal to you, could be environmental in terms of something that happened to the actual property, zoning change, condemnation, something happened in the neighborhood, and you can prove, hey, we plan to own this thing for a long time. We plan to manage it, whatever it may be, but we're going to sell it quickly. That may qualify for 1031 purposes because the IRS looks at intent. If you're talking about repurposing the property, so going from personal use to investment property or something to that effect, typically speaking, you're going to hear tax preparers say, we want to see rental income in at least 2 tax seasons. So 12 months of rental income, straddle the year, report income in 2021 and 2022. If you do that, you're typically in pretty good shape.
Great. All right, Raymond, should I exchange my property or let my kids do it after I'm deceased?
Well, there's really no point in your children doing an exchange after you're deceased because there won't be any tax consequences associated with the sale. So when we look at that and we know that there's benefit in owning real estate, investment real estate until you pass away, because we're working toward that step up in basis. It's a phrase that you'll hear used called swap until you drop. I mean, arguably the best tax strategy available with real estate. So we know you want to either hold the property or defer your tax liability and keep owning investment real estate until you eventually pass. The question is really between now and then, between now and your eventual passing, what's going to be the best property type, form of ownership, et cetera, in order to own. And many people are saying, well, that's where the Delaware Statutory Trust comes into play because I'm 65 years old or 72 years old and I don't want to keep managing my 20 unit. So I'm going to reach out to AOA, I'm going to get a BOV, I'm going to then sell that property and create a diversified portfolio of properties that I don't have to manage or really think much about. I just get an ACH direct deposit of my income. Every 5 to 7 years, I make another decision as to what I'm going to exchange into. It's hands-free. I can divide it up among my children and they have the full step up in basis still. So I wouldn't I wouldn't have your children exchange after passing. Once you pass away, they're probably just going to take the sales proceeds because there's no tax consequences.
All right, Lawrence on YouTube. What are the disadvantages of DSTs?
You know, the DSTs present all of the same risks that we know and love with investment real estate. There's interest rate risk, inflation risk, market risk, regulatory risk. So it's not like it's absolved from those. Can you mitigate that or diversify against that by having higher quality institutional properties and diversifying among different property types and geographic areas? Yeah, absolutely. The one element that is really unique to the DST that is likely not present in the properties in which you own today is going to be the interplay with what's referred to as the DST sponsor, the firm that is managing that property, making all of the operating decisions, and eventually making the decision of when it's going to be best to sell that property. It's very important that you feel comfortable and confident with that entity or those entities if you have a broad portfolio, because they do have, frankly, all the control over it. And that control component is an interesting one I talk to owners about regularly, because the lack of control associated with DSTs is either the worst feature of DSTs or it's the best feature with DSTs. And for most people who are considering exchanging into them or do exchange into them, it's both of those at the exact same time. You can't have control and not have management responsibility. It doesn't work like that. So you either give up both or you retain both. But many folks are saying it's worth it. It makes sense. I understand the due diligence process that's happened on these sponsors. They are institutional firms that have long track records, make investor-centric decisions. Okay, I'm good with that. Let's move forward.
All right, great. Donatelli Family Videos. Can I sell my apartment building in exchange for a property that we will build ADUs? Also, can I sell? Okay, yeah. So I'll just do that. Just stop there.
So you can do what's called a improvement exchange or build to suit exchange. That allows you to take your exchange proceeds. Say you sell a property for $2 million, you can go buy $1 million of land and then use a portion of those exchange proceeds towards funding the construction costs improvements. It's a little bit more complicated. It's becoming increasingly difficult to do in today's environment because of contractor delays, material delays, et cetera. And importantly, the only dollars beyond the purchase of the land that will qualify for exchange purposes are going to be the dollars that are actually spent, and not only spent, you can't prepay, but put into the ground. So you actual completed construction costs. So you can do that, but if anyone is going to consider doing that, you better have your ducks in a row in the sense that your project, before you purchase it, better be fully permitted, it's shovel ready with contractors lined up, ideally materials coming in short order, because you only have whatever the date is, number of days from the date of your purchase of the property through 180 to actually be working on building that property. Otherwise, no, you can't exchange into construction costs unless you do it with an improvement exchange structure.
All right, good question. Maria, will 1031 exchanges be eliminated with Biden's new tax proposals?
Moving target throughout the course of the year, and that's something in which we're very in tune to, and definitely keeping track of what's coming out of Washington. We are increasingly optimistic that not only will there not be any meaningful change to Section 1031, but we don't think that at this point there's going to be any changes made to it. If you want the history on that original proposal, call it a campaign promise back in 2020, was outright elimination of 1031 exchanges. The IRS backed off that, not even the IRS. The IRS is really not opined on this at all. The White House backed off on that, and then Congress backed off on that in, call it, early spring of 2021, in which they said, oh, we're probably not going to outright eliminate it. And we're probably looking more at limiting it so that an individual can have up to $500,000 of gain deferred in any given calendar year. So $1 million of gain if you're a couple. So they're trying to eliminate exchanges for those that are doing larger property sales. Then, after much uproar from the real estate industry on that proposal, then they ultimately removed it from the House proposal. So the House Democrats made a tax proposal for the infrastructure bill about 3.5 weeks ago. No language tied to 1031 exchanges included within that. We do expect that capital gains rates will go up, likely from 20 to 25%. You may see depreciation recapture rates go from 25 to 30%. You'll certainly see marginal income tax brackets go up and the thresholds probably go down. And then we do also believe that you'll see the estate tax exemption amount federally to come down as well. Right now it's 22 plus million for a couple. I'll probably get cut in half or so. So there's going to be some meaningful tax change, but we don't think Section 1031 at this point looks like it's going to be touched, which is great news for all property owners and anyone who works in the real estate ecosystem as a whole, whether you're in title or escrow or a lender or broker, or it really doesn't matter. Exchanges benefit the industry.
Great. And here's Virginia. Can you exchange for a vacation home?
You can exchange for a vacation rental because it's held for business or investment purposes. But if it's a pure play vacation home, personal use, then no, that does not qualify as held for business or investment purposes. The rule there, real quick, the delineation is if it's both dual purpose, it's a vacation home and you have rental income derived from it, it's going to be classified as personal use unless your personal use is less than the greater of 14 days out of the year or 10% of the days in which you have rental income. So you rent it for 120 days, you're limited to 14 days of personal use. You rent it for 220 days, you can use it for 22 days. You use it for more than that, now all of a sudden it's a personal use property, not investment property.
Great. All right, Barbara on YouTube. What are the sales tax implications of eventually moving into your replacement property?
Sales tax isn't applicable for real estate, but capital.
Maybe
gains,
she means capital gains tax on.
So if you're interested in seeing what the capital gains tax would be on your property if you were to not do a 1031 exchange, you can visit our website. We have a exchange tax calculator there. But when we're talking about California property where there's not an excise concept, then you're looking at full tax deferral. So you're deferring capital gains at the federal level, depreciation recapture at the federal level, net investment income tax at the federal level, and state capital gains, which is state income tax, on top of all of that as well. Now, if you're talking about income tax, if you exchange out of California, you may have out-of-state income tax applicable depending on where you exchange into. Not Nevada, not Washington, not Texas, but you exchange California into Arizona. California is going to both tax that income and Arizona will tax that income too. You get a credit for the amount of Arizona tax paid though.
All right, here's a good question from Yoko. We're in California in their 70s, want to sell farmland and rental properties. Can we combine the proceeds from all as a 1031 exchange?
Broadly speaking, yes. It depends on the ownership structures of those properties as to what the ownership of the replacement property would need to look like. Really, you're looking at if they're owned in the same entities or disregarded entities, you can go ahead and combine them into a single exchange. If they're in separate entities that are regarded, then you're looking at combining them in a tenant in common, but you can collapse them into a single entity after the fact. So yes, you can do that.
Great.
It requires syncing up the timing of those sales, though. That is far easier said than done.
All right, Kendall. If you move into a property that was your rental after buying in a 1031 exchange and make it your principal residence, what are the tax consequences?
No tax consequences. So you have just repurposed the property. You're welcome to do that. Now, if you were to eventually sell that property, you would not be able to utilize a 121 exclusion. That's the 250,000 of gain as an individual, 500,000 as a married couple that you can take tax free. You're not allowed to take that 121 exclusion on that property until at least 5 years after you purchased it, if you exchanged into it. But we have clients that we work with all the time who say, okay, I'm going to sell a $6 million multifamily property. I'm going to take $2 million. I'm going to exchange into a home in Palm Springs. I'm going to have it be a rental property for a year, and then I'm going to move into it. And then take the remaining proceeds and exchange into income producing properties. And that's a great way to use your exchange dollars.
All right, here's Jeffrey on, okay, our LLC 10-unit apartment property is currently worth $3 million. If we sell, can we buy 3 separate properties totaling $3 million or more?
Absolutely.
All right, Jeffrey. Good name. All right, back to Jim up at the top. Okay. Oh, is there a way around the California clawback?
You can die. Only if you die. Yeah.
Okay, if we pay off a multifamily property with an inheritance received, do we have to move the entire sales revenue to any new purchase at the same value or more as the sold property to avoid any tax with the 1031?
Yes. Yes, you do. Which begs the question of whether you should take the inheritance proceeds and pay off the property or not. You may just want to sell it without having paid it off then.
Okay, Donatelli, family videos. I think we did this one, but can we sell my apartment building to build ADUs on my existing property?
Yeah, we covered that one.
Okay, is the real estate transition solutions, the same company that's in San Francisco, 1 Market Street, 36th floor, San Francisco?
That is correct. Yep.
Okay, you've been identified.
Found us. Yep.
All right. And do you have a way to convert community property in California to an LLC in a non-community property state?
So to convert it, I mean, you can sell that property, exchange into new property, and then put that property into an LLC. That's not, I wouldn't call that a conversion per se, but that's an allowable transaction.
Okay, thanks, Jim. Okay, Lucy Simple. If the capital gains is less than 500,000, that's the current California tax exemption for married couple, does it still make sense to do a 1031 exchange?
So that 500,000 is specifically for primary residence sales, not for investment property sales. As to whether or not an exchange is suitable, it depends on, are we talking about a $1 million sale or $5 million sale? Is that 500,000 represent 80% of the tax liability or 5% of the tax liability? So there's a lot of nuances there. Do you have liquidity on hand? Do you need cash on hand? It's something in which we dialogue about regularly with property owners to get to the bottom of that. Should you or should you not exchange? But I can't opine on it with that information.
Great. And we had 3 different requests on YouTube for the slides. Are you
Okay.
able to furnish the slides?
Sure. Yeah. No, we can certainly do so. We'll have our marketing team send them over to AOA, and then do you want to just put a link to them in the YouTube?
Yeah, we could do that, or we could send. Well, yeah, we'll figure it out one way or the other. Probably put a
Okay.
link in there. Great.
Perfect. Yep, that works.
Great. And then there were other requests for that reverse exchange too. So that was interesting.
Okay.
That sounds like something other people are interested in. Okay, Jay Price. Say I sell 4 million multifamily and buy a house in DST. How long do I have to rent house before I can move in without any tax?
It is, you want to rent it for a period of time. As to how long you choose to rent it for it's something in which it's really up to you. The intent should be to rent it upon purchasing it. I would definitely, if you're going to get a loan on it, I would 100% get a investment property loan on it. Do not go get owner occupied debt, because that's a huge red flag right there. But I'd feel best with a year of rental income. That being said, if you're trying to do it as a vacation rental, for instance, and then it doesn't seem like it's working out, and maybe you need to move for some reason, then it could happen earlier. I would probably wait to do that in a different tax season, though.
Right. And you had kind of said if you straddled it over 2 years, that'll be better.
That's helpful. Yeah.
And
the reality is too, you can do anything you want with the tax code. The question is, what's the likelihood that you get audited? California loves to audit exchanges. Franchise tax board is all over them. And then in turn, do you have a supportable case if you do get selected for an audit?
Great. And it seems like they're trying to increase the number of auditors for the federal tax. So keep your, just stay straight down the road, and you'll avoid all the pain and headache of that, hopefully.
Yep.
And anyway, I forgot to mention the AOA membership price. It's been the same for a long time, but it's going to be going up January 1st. And so I just did, as a courtesy, just wanted to mention that if you're a current member, you can extend 1, 2, 3 years now at the current price and avoid having to pay more when your membership is about to expire. You don't lose any days doing that, but I just thought I would mention that. And we have a digital version now too. When you extend, you can get a digital version of your membership packet. You'll still get your magazine every month in a hard copy, but that also ends up giving you, we throw in a couple bonuses with that, Pathway to Wealth, which is just covers 12 different areas, a system and how to manage. And so that's a great resource. And then another one about tax, saving money on estate planning, I believe. So anyway, thought I'd mention that before we wrap it up here. And Austin, this really good. It's taking the extra time to cover it thoroughly like that. I think this is probably best one that you've done so far.
No, I appreciate the positive feedback. And like I said at the beginning, always enjoy the opportunity to share with the AOA membership. You've got it.
Great. And anyway, so next week, there's just more content coming, and we'll keep you posted. John Kupal with Howard Jarvis, Taxpayers Association, is coming up in a few weeks. We have we have one on how to prepare for small claims court. We've covered that once before. Franco Simone from San Diego is going to be covering that one, and it'll apply to just about everybody in California, I believe. Help you prepare for that if you are owed money from that COVID time period. So hopefully that'll be helpful. And wow, we have all these questions popping in now all of a sudden. But what's your schedule looking like?
I'm going to have to drop off here. But,
okay, yeah, so we're done.
Folks are welcome to reach out to and visit the AOA portal that we have. So
hey, can we get let's just make sure we get his phone number and email address up there. But then also in YouTube, at the bottom of it, if you click on that more, there'll be some information there for you. Great. Yeah, there it is. Okay. Thanks, guys. And thank you, everyone. And hopefully we'll see you next week.
Excellent. Thank you, Jeff. Have a
Okay,
good
awesome.
afternoon.
Take care.